Welcome back to the Free from Wall Street podcast. I have a great friend and mentor here with me today, Yonah Weiss. How are you doing, man?
I am doing wonderfully, Steve. Thanks so much for having me.
So I love the fact that you are big in the multifamily space. You have a lot of mutual friends that we do, and you and I live just a couple of miles away from each other.
It's not too far. Yeah, we actually had the pleasure of having lunch not so long ago before this whole COVID thing took over the world.
Yeah, it's a small world. I mean, because I was looking for some help with some information on cost segregation studies, and your name kept popping up, and I was like, wait, where does he work at? And oh, he works at Madison, and I know a lot of guys over there as well. And it was a pleasant surprise to have somebody just right in our backyard that we'd be able to go kick around some of these deals with. So, well, thanks for coming on the show. Appreciate having you. For those of you that are listening, don't know Yonah, he is at Madison SPECS. He does cost segregation studies for a lot of operators around the country. And I'm going to let him get into that. But if you've listened to the show and you're listening to how the commercial real estate space in particular is more tax advantaged than almost any other asset class, this is a huge reason why. So listen up. Listen to what it is that we're talking about. And this is how a lot of our operators and how, some of our passive investors are going to be paying limited taxes to no taxes on their returns on to some of these purchases that we're doing. So I always like to say, Yonah, you're always the most popular guy in the room.
That's right. It's great to work in a profession where everyone loves you.
Right. Yeah. You have a win-win, you come out, you tell people, hey, for this amount of money, I can save you about this amount of money in taxes. I mean, you don't have to pitch any bad news ever.
It's pretty much a no-brainer once you understand what it is and it works for your situation. And a lot of people tell me there's like no sale involved in this. This is a great service, but it's just like, why would I not do this?
Yeah.
And there are a couple of reasons. Maybe we'll get into why one might not do it.
Sure.
Specific situations, but otherwise, yeah, it's crazy. Most of the time, the reason is people just don't know what it is and don't understand it.
Yeah. So why don't we start there? So give us a little bit of background. How did you get into this space? And then what does your job really entail and how does it relate to investment?
So what I did, I got into the space really not so much as the cost segregation side of things. My background is really in education. So I've been a teacher for about 15 years, and that's kind of my thing. I wanted to get into real estate at about a certain point, about 5 years ago, and I bounced around different things, doing some brokering, doing some commercial mortgages, doing some fix and flips, and just kind of getting my feet wet and everything involved in both residential and commercial real estate. And I came across this company, Madison, who has a wonderful name in the real estate community. Especially out, here in the Northeast. And there was a position with this cost segregation. I really didn't know, 5 years ago, what cost segregation was, like many of our listeners. But I had the amazing pleasure of learning from the real experts in the industry. This company's been operating for 15 years, and the principals and founders have been in the space for decades, and our accountants and engineers. So I literally learned from some of the experts in the industry. And because of my teaching background and my abilities, I just kind of fell right into that niche of understanding it and being able to give it over in such a simple fashion so everyone can understand. And that's really what I do. My job is more facilitating, business development and education more than anything else. So we have a full in-house team that actually does the work. So engineers, accountants that are really doing the studies, doing all the work. I leave that to them because they are truly the experts. And I, call myself the expert because I'm able to give over this expertise in a way that, the accountants and engineers are a little bit more boring.
Sure, you bridge the gap between the technical side of it and kind of the ideological side of it, which for guys like me is hugely important, right? Because I don't necessarily want to know the nuts and bolts. I want to know what's the benefits, what's the tops of the waves. And, I think a lot of the visionary type operators are going to be that way. Maybe there's some technical guys that want to talk to the CPAs, but you do a great job of kind of bridging that gap.
Exactly.
So what is cost segregation? What is the study? How do you go about performing it? Who's it for? Give us a little background on that.
Yeah. So the first step of understanding cost segregation is understanding depreciation. Because cost segregation is really just like an advanced form of depreciation. The IRS gave this really cool tax deduction if you own a property, if you own a commercial property, any type of investment or business property, anything excluding your personal residence. When you buy that, the IRS says, hey, you can now take the entire purchase price, subtracting a little bit for land, which doesn't have depreciation, and you can now take that as a tax write-off, the entire amount. So you buy a building for $10 million, you can now take a $10 million tax write-off from your income tax. Only problem is you have to spread that out over a long period of time. So you get a little bit every single year for residential properties over a 27.5 year period. And for commercial properties, anything besides, single family or multifamily, it's over a 39-year period. So that $10 million is great to have those deductions, but you really get about, $20,000 to $30,000 a year. 200. We're talking about 10 million. So, $200,000 to $300,000. So about 2 to 3% of the actual purchase price you get to take as a tax write-off every single year, and that's great. But this is where cost segregation comes in, because in the tax code they actually break down that, listen, depreciation, we're just giving this tax deduction based on the principle that the building's going down in value, right? That's what depreciation means. But it's really not. I mean, it's probably going up in value. But there are other components in the property that actually do go down in value as time goes on. And so they have a much shorter lifespan. So the tax code delineates what are those things and what lifespan they have. But the trick is that you actually have to have an engineer or someone with construction engineering background and the accounting, abilities, to understand what says in the tax code to then go ahead and identify and break out what all of those different things are in the building. So just to kind of simplify that, you buy a multifamily property, the walls and the roof and the windows and doors are considered structural. They last a really long time. Okay. Yeah. Those you can write off the value of all those things. You write off on a 27.5 year schedule, but there's stuff in the building like personal property, anything like furniture, cabinets, even though it's attached to the wall, it's still movable, carpeting, fixtures, appliances, all kinds of things that are in the property, not part of the structure. The value of those items can be identified by an engineer, what that is, and then depreciate it on a 5-year schedule. So you can actually take the value of that as a tax write-off over a 5-year period, as opposed to lumping it together and just taking, like I said, a 2 to 3% of the purchase price every year for 27 years. You can actually front load, in many cases, 20 to 30 or even more, 20, 30% of that property over the first 5 years. So we're really front loading a lot of those tax deductions. And so that's, kind of things, what you talked about at the beginning, Steve, is that this is one of the biggest wealth builders, using the tax code and understanding how real estate is, the best assets, the best type of investment vehicle to also get those tax benefits.
Yeah, it's incredible because this year in just the operations that we have, we're looking at somewhere in the vicinity of $10 million in depreciation. And now that gets spread out between us and our other partners and our investors and things like that. But that's huge, right? I mean, in 1 year to be able to take a $10 million loss, regardless of how many people it's spread over, you're talking about significant deductions against passive gains or active gains, or, talk to your CPA about exactly what you can apply those things to. But this is a huge piece of why we even shut down the residential fix and flip business and moved into the commercial businesses, because the tax benefits make this a real no-brainer. It was a no-brainer before. It's still a no-brainer. People have been using the tax code to their benefit, which you should be, by the way. If you think that you're cheating by doing something that the tax code allows for, you need to read a book called Tax-Free Wealth by Tom Wheelwright, which really does a great job of explaining that the tax code is written like this for a reason. And that reason is to get you to do things that the government wants you to do, like buy multifamily housing. So there's a lot of benefit to it. And when we were paying huge chunks of money to Uncle Sam when we were flipping houses, and then now we're buying tens of millions of dollars worth of property, hundreds of millions of dollars worth of property, and not having to pay taxes on it, it just blows your mind when you realize that this is possible.
Yeah, it's possible. And like you said, I mean, that's a great book. Tom Wheelwright's book, Tax-Free Wealth, because like you said, he lays it out for you, showing you the path. And it's part of the, I guess, the mindset and, for lack of a better word, the brainwashing of Wall Street and of, that's telling us, corporate America, that when you make money, you automatically take a deduction from your paycheck that goes to pay taxes. It's not even yours. So real estate is different because you don't get anyone deducting, from your income. You have to now apply that. But first, before you apply that, take all the deductions that you can, right? All of the write-offs, all of the expenses, everything like that in your business, and you're left with all of that income. And in many cases, like we're doing here, the cost segregation is we are creating negative. We're creating a paper loss, which means that you made all that money and you pay zero taxes on it because you have no tax liability. And it's not, like you said, it's not cheating anyone because it's just making sense. Now, people might want to make you think that, yeah, you have to pay taxes and paying high taxes is great. But if you're following all the rules in the tax code and doing this legally, that's the best of both worlds. Like, it just drives me crazy when I see like headlines. I remember last year, Jared Kushner, hasn't paid federal income tax in 10 years, right? New York Times headline. Right. But if you read the fine print, he used, tax, and they even used the word like, tax deferrals and things like that. Like, tax, I don't know what they were trying to say it in the nicest way, but what they were insinuating was that the guy is doing illegal activities. That's what they were insinuating. But he was just using cost segregation and other tax strategies.
And I mean, the reason that the government says this is why we're going to reward you for doing this is because it creates tens of thousands of jobs, right? It creates housing for people. There's a lot of benefits to it too. So, if you have a problem with how the tax code is written, that you have to take it up with the IRS, not the people that are trying to utilize it in a way in their business to minimize their taxes. I mean, I think for you to pay more in taxes than what you should be paying is a problem, right? Yeah. I don't think taking your deductions is an issue. The two biggest lies of Wall Street, or lies that kind of society has taught us, is one, you're not smart enough to manage your own money, so give it to Wall Street. Mm-hmm. And two, there's only two guarantees in life, which is death and taxes. And it's just not true, right? Now, is it a fact of life? Yeah. Do you have to pay it? No.
Right.
So interesting. Okay. So now we go and do a cost segregation study. You guys will come out, you fly out to a property, you're doing the engineering reports, you're analyzing what we can accelerate, what we can't. You give now me a report, and what do I do with that report? I know what I do, but what do you tell us?
Sure, absolutely. Right. So just like you said, our engineers, and we're actually, Madison, we're the largest cost segregation firm in the country. So we're working in all 50 states. When our engineers go to that property, they'll go out and they'll measure, they'll take pictures, and they have to document everything in the building and, everything around the perimeter of the property as well. Because another thing I didn't mention is that land improvements is another category that depreciates faster. So pavement and concrete and landscaping, those kind of things, on a 15-year schedule. So yeah, he will come back, create that report. It's usually like 80 to 100 pages long, very detailed, sourcing the tax code. There's a whole numbering system. There's a whole nomenclature that has to be used. It's like, you have to jump through all the hoops in order to do it right. But what it does in the end of the day, it just produces a depreciation schedule, which that's really all that you need. You need that, and you take that and just plug those numbers directly into your tax return, and that's it. And if you have investors with you in an LLC, so you are preparing those K-1 forms for them that show them how much their portion of the income from the properties are and how much their depreciation and what the losses they have. So oftentimes, like you mentioned, you're having these huge tax deductions, right? You make $10 million of profit, of net operating income, but you have $10 million deductions, right? Or even more sometimes. So that's being spread out amongst everyone according to their percentage of ownership, according to how they are split up in that LLC.
Yeah, so I'm an active investor. Obviously, we're operators, but I'm also a passive investor in some other deals. And last year we got involved in a small project. We put 100 grand in. I get a $58,000 K1 loss sent back to me, which just added on to some of the other losses that I was able to take. So what does that mean? If I take a $58,000 loss on a K1, what does that mean to me personally if I have income that exceeds that?
Right. So having a loss means that you have more deductions than you actually have income. So you're showing all that money you're keeping and you're showing a paper loss. Okay. It's not a real loss. You're actually making money. You're not
Right.
losing it. Just to clarify that for anyone. What that means is depending on whether or not you are a real estate professional. Okay. And so maybe it's a good time to get into define that, because if you have that status, and this is a tax status, it will depend on how much you can benefit from those losses and where you can apply them to. And again, this is obviously going to be a question, this is not tax advice for you. Make sure you discuss this with your accountant, your tax advisor. But simply speaking, a real estate professional is anyone who either they or their spouse, okay, one of you, has to spend more than 50% of your time involved in materially participating, okay, in the real estate trade or business. Because that means anything like if you own properties and you're managing them, you're working on construction and remodeling, brokering, acquiring, any of the processes involved in real estate trade or business. And you're spending, the second qualification is spending 750 hours a year. So it's not a lot. It's like about 16 hours a week. If you break it down, you're working every week.
So not waking hours, just minimum working hours, right?
Working hours, yeah.
Yep. So when you say half your time, it's not like 12 hours a day on the earth. It's at least 700 hours a year is spent.
Right. 50% of your working hours, and it has to add up to 750. So you have to have both.
Yeah.
You cannot just sit on the beach all day.
That's the litmus test.
Exactly.
Okay.
And the great thing is that, and I'll get into what the benefit is in a second, but the great thing is that it's either you or your spouse. So if you have a spouse that's who's not working, maybe they stay home, they can be involved in real estate. They can be managing properties. They can, be looking at deals, underwriting. They can be involved somehow in that business. And now we're going to get to the punchline of what does that mean? How does that translate? And how that translates is that you can, if you're a real estate professional, you can use those passive losses against your active income as well. Okay, so let me just take a step back and break it down. Depreciation is considered a passive loss, a passive deduction. It usually just goes against your passive income. So any income from real estate, any properties, doesn't matter how many you have, all that income is pooled together, and that's considered passive income. Your depreciation, and a lot of depreciation with cost segregation, is going to be used first and foremost to offset that income. If you have, like in your situation, Steve, that you had a K1 loss of $58,000, that means from the passive income of your property or your investments, you had more deductions than you had income. Now we play with the real estate professional status. If you're a real estate professional, you can now use that $58,000 against any of you or your spouse's active income as well. Okay? If you're not a real estate professional and you're making over $100,000 of adjusted gross income a year, then, over $150,000 of adjusted gross income, then you cannot use those passive losses for anything. They just remain a passive loss, which means you don't lose them. They kind of stay in like an imaginary bank account and carry forward with you. You can use them next year.
Right. So you have some losses. Mm-hmm.
So you have some income that that can be used to offset.
It gets offset.
So that's basically what it is. So I would highly recommend, anyone who is thinking about taking the jump, and I love it because I have so many clients that just like reach out to me and like, either they're real estate professionals already and they're like, I don't know why I wasn't doing cost segregation before because I was just paying taxes and now I'm doing it and I'm not paying any income tax, or that these people were real estate investors passively and they decide they saw these losses coming on their K1s and they're like, listen, I'm just going to jump in and go full-time into real estate because it's worth it, because I'm going to be making more money, paying less taxes on it, making more money by being involved in real estate full-time. So I love that when I get messages like that.
Right. It's such a big deal too. I mean, if you compare my 2019s to my 2020s, right? 19, we shut down the fix and flip business, but we did, I don't know, 180 flips. And the income from that was highly taxed. I worked for 40% of the year for the IRS, right?
Mm-hmm.
Now this year, we won't pay anything in taxes. So when you guys start to realize, right, that the money that you make is good, the money that you keep is great, and you can figure out ways to minimize these losses. I mean, so this is a huge deal. I mean, look, even the advantage of being able to take the whole property loss over a 39-year period of time is a
Mm-hmm.
big deal.
Right.
But when you start to accelerate these things and you do cost segregation studies and you start to create these massive losses, these massive paper losses, then it really becomes a game changer. And I think what's interesting to me about this is that the wealthiest families in America do this stuff.
Yeah.
And, we're not here to reinvent the wheel. We're no smarter than anybody else. I mean, you were taught by some great mentors. I was taught by some great mentors. And really, it's a game of chess, right? You're trying to figure out how to maximize your income, minimize your liabilities. And then that's how you can create, preserve, and pass on generational wealth. That's how it's really created, which is what I love about what it is that we're talking about.
100%. And I want to just touch on one aspect, because I understand that probably a lot of the listeners here are passive investors. Okay. Maybe they haven't reached that point where they're full-time real estate investors. And I want to just touch on the point, how is this benefiting them? Because we mentioned the real estate professional is going to get huge benefits from this, but even still, the passive investor, okay, let's say like you're Steve and you put $100,000 into a real estate syndication, into a deal, and you get this loss. What does that mean? How does that translate? That means that your returns are tax-free. Now, what other investment vehicle is there that you can get returns on your investment, at a pretty, won't even get into the fact that it's a higher rate, potentially, 8, 10%, return or whatever that
typically
is.
you get a good yield and it's increased because you don't have to pay taxes on it.
Exactly. And so
we did a quick calculation on it. And if you're, let's just arbitrarily speaking, 12%, if you're making 12% per annum on your money through these investments, which is fantastic, and you were paying a capital gain on that, and this is offsetting that, your true rate of return is really 13.8%, right? Because now you're not paying an effective tax rate. So yeah, I mean, 12% tax-free, 13.8% tax, however you want to say it, right? It's just when you don't have to pay taxes on your gains, it's a big deal. And then most of these passive investors are not just passive in one thing. Some of them are doing some lending on the side. Some of them are doing, some private lending for whatever they're doing. And those could be passive losses. And again, this is a lot of tax information that you have to talk to your CPA about. But when you start looking at the depreciation, even as a passive investor, it just pours gasoline on your returns.
Right.
So really good stuff. So Yonah, we have a couple of deals that we're going to be doing together this year. So we're excited to get out to some of our properties where we get to go walk around and kind of see what we're doing. And we've done some just estimates and stuff. So we know that it's for us, but who might not want to do a cost segregation? Who would maybe want to avoid it, or why would they want to?
Sure. Like I mentioned at the beginning, this is not necessarily for everyone. And the first and foremost is if you're not a real estate professional and maybe you just have some investments on their own, it may be beneficial, but it may not be. One of the things that we always do is we provide an upfront, analysis, and it's no cost, just an estimate to show you what the potential benefits, tax benefit is going to be if you run a full cost segregation study, just in order to kind of educate you. Like you mentioned, you saw that, what you're looking at, what that's going to be. Any property that is purchased for under $500,000, I usually don't recommend it, because when we're talking percentages and we're talking about, a 10% or a 20% reallocation of those assets to a faster depreciation. So, a $500,000 asset, if you're going to reallocate 10%, that's $50,000 of accelerated depreciation, extra depreciation those first 5 years, but that's an extra $10,000 deductions a year. Is it worth paying a few $1,000s for the study to be done in order to get, that tax deduction? It may be, but I usually don't push it just because it's kind of borderline. When you get over $1 million, it's just a no-brainer. You're talking about, 10, 20 times the, return on investment from that investment of paying for the service itself.
Yeah.
But a couple other things that may not be beneficial is, number one, if it's a flip, okay? If you are not holding a property for more than a year and your intention is just to buy and sell it, you actually don't take depreciation deductions, which is what Steve was talking about. The flipping business, you weren't getting any of these deductions. That was considered, active income from a trade, a business. So obviously, if you're flipping a property, and even if you're holding it short term, I'd say even anything less than 2 years, it also may not be beneficial. It might be, but it's worth checking that out to see if you're going to benefit from that. The third thing I would consider is I'll talk about a few more after this, but the third thing is what type of property. We talked about multifamily properties, but really any type of commercial property can benefit. The one type of property that has the minimal benefit from anything is usually like a warehouse, for example. And that's just simple. If you think about it, there's really nothing in there besides for the structural components. Maybe there's some shelving, maybe there's some lighting, but besides that, it's very minimal.
Sure.
So that's another type of asset class. Other types of asset classes are great. Office, even other types of industrial properties that are more like, distribution centers or things like that, where they do have a lot of electric and a lot of components that depreciate, lifts and all these kind of things. They're going to be better off. Otherwise, self-storage is awesome. For mobile home parks are tremendous for cost segregation, and the list just goes on and on. One other thing that is important to understand is that it's become popular of late to invest with your retirement account. Okay. And you can do that. And I highly recommend doing that. If you have a retirement account, don't let Wall Street, put a stranglehold on your retirement account. It's actually yours. And there are many ways that you can have a self-directed retirement account where you can kind of take the control of that money into your own hands and invest it. And there are laws and there are rules to do it. And there's plenty of, fraud, I don't know, I want to say fraudsters, but people out there who are just trying to take your money and redirect it. So be careful when setting something like that up, that it's, done by someone reputable. But doing that in certain types of investment vehicles, retirement vehicles, it's tax-free. Okay. If like in a 401k, for example, that's tax-free money. If you invest that through a solo 401k or a qualified retirement plan, you can get the returns, but those returns are tax-free already because the money was from a tax-free account. You can't benefit from the depreciation.
Right. So IRA investors, 401k investors, it's already in a tax-advantaged vehicle. So they don't allow you to take depreciation against that already tax-advantaged vehicle. So Here's what we recommend is, everybody has to do their own analysis on this, but this is what we recommend. Right now, the CARES Act is allowing for a $100,000 penalty-free withdrawal. So usually when you just take money out of your 401k, you get hit with a 10% penalty. Right now, that's because of COVID, you can get away with not paying that penalty. If you decide to not partner with the government long-term, I've never known the government to decrease taxes. So, the guy who created the 401k said he created a monster by doing so. A lot of people think that it's a great thing because that they are deferring their taxes, but you're deferring your taxes until arguably your net worth is the highest it's ever going to be. So you're going to actually increase your tax basis, not decrease it. And if I know anything about the government, they're going to increase spending, not decrease it over time. So by the time in 30 years when I retire, tax rates are probably going to be higher. I don't have a crystal ball, but assuming that the government continues on their spending spree, then maybe that's something to look at, is to say, do I take the penalty? I mean, I know people that have taken the penalty before it was waived.
Right.
Now they're taking the penalty, and because of the depreciation, they're offsetting some of their taxable events that they're creating through that too. Now, if you're just going to roll over, right, then yeah, go ahead and roll it over into a self-directed. There's plenty of qualified intermediaries out there that we can refer people to that do a great job. And then you can invest through those accounts. For me, because of the long-term tax benefits, I'd rather take the hit now, roll it into, let's say, just a straight cash account, or if you don't like that idea, then maybe a Roth IRA to where it continues to grow tax-free. Won't get those tax benefits as well. But if you can figure out a way to convert it into cash, you have the tax advantages now to where you're not partnered with the government long-term, and you can just pay it now and then carry it forward. So a lot of different options that are available for people. But the biggest thing is this is an asset class unlike anything else. I think only oil and gas has better depreciation statistics, and there are literally hundreds of thousands of tankers sitting in the ocean right now filled with oil because there's no demand. And there was this trade war between Russia and Iran, one of the I's. And they kind of put all this production out. So now there's a bunch of oil sitting out there. So oil prices went negative a couple weeks ago. So that's maybe a little bit more of a volatile investment with those depreciation gains. So here, because we're anti-volatility, we want downside risk protection, but also the best tax benefits that we can have with that downside risk protection. So it's a ton of great information, Yonah. So if other operators are listening, or just people want to reach out to you and kind of learn more, I know you have a podcast coming out. Where can people reach out to you?
I'd say the best place to find me is on LinkedIn. I spend a lot of time there. I put a lot of content, very engaged daily. So that's a great place to find me. And like you said, Steve, we're launching Weiss Advice next week. I don't know if it's next week when this airs, we hear this, but check it out anywhere where you listen to podcasts. We'd love to. It's not going to be about cost segregation. So you already heard that.
Yeah, right. That's a good point, though. Not coming to just listen to more about this.
Exactly. We're going to be talking about all kinds of other stuff, related to business and investing and real estate and life. So check us out there.
Awesome. Well, Yonah, thank you so much for spending the time with us. Thank you for the education, and we look forward to hanging out once we get out of quarantine here. Look forward to grabbing lunch again.
Awesome, Steve. Thank you.
Thank you.